Rivian Automotive Inc. is currently trading at $18.26 per share, representing a sharp intraday move of over 8.41% upward on heavy volume, following one of the most volatile weeks the young electric vehicle manufacturer has ever faced. Looking at the charts right now, this swing brings some temporary relief to investors who are absolutely hammered just 24 hours ago when the company caught the entire street off guard with a massive capital raise. Yesterday, the stock suffered its worst single-day rout in nearly 2 years, crashing down to near the $16 mark after management announced a surprise public offering of 75 million shares of Class A common stock, with an option for underwriters to purchase an additional 11.25 million shares. That sudden dilution plan wiped out a massive chunk of value in a matter of hours, showing just how fragile the market narrative remains around scaling an automotive business. But what most people are missing in today's rapid rebound is the structural shift in who is actually buying this dip. While casual retail traders on popular trading platforms were panicking about the 6 to 8% dilution, institutional block orders began quietly filling up at the open. The reality behind this massive capital injection is that Rivian is intentionally clearing the runway for its highly anticipated R2 platform, which recently began its first public customer deliveries. By securing an extra $1.5 billion in liquidity right now, management has effectively removed the immediate existential threat of a cash crunch through the end of next year, even if it meant stinging current investors with a surprise dilution. This creates a fascinating dynamic in the market, where the short-term technical damage is fighting against a much stronger medium-term fundamental floor. The general expectation across retail forums and major investment sites was that Rivian had finally turned the corner after its blockbuster second-quarter delivery report. Just days ago, the company announced production and delivery figures that comfortably beat consensus estimates, prompting management to actually raise their full-year delivery outlook. The market reacted with euphoria, sending the stock up nearly 20% in less than a week. Investors genuinely believed that the days of desperate capital raises were over, especially with high-profile partnerships keeping the company afloat. The reality, however, is that building electric vehicles is an incredibly punishing, capital-intensive business, and a delivery beat does not instantly erase a quarterly cash burn that analysts expect to land around $0.79 per share in the upcoming earnings report. When you look at how this stock is trading across individual brokerage platforms like Robinhood or SoFi Invest, you can see a massive tug-of-war. Trading volume has skyrocketed past 90 million shares today, which is more than double the company's recent daily average. This kind of liquidity surge tells us that institutional investors are repositioning themselves. For months, the bears argued that Rivian would run out of cash before the R2 and R3 models could achieve true mass-market scale. By executing this underwritten public offering right after a positive delivery report, Rivian used its stock price strength as a weapon to shore up its balance sheet. It's a classic corporate finance move that professional portfolio managers respect, even if it frustrates shorter-term active investing strategies. To truly understand why the stock is behaving this way, we have to look at the broader ecosystem of online investing and how sentiment shifts. If you monitor high-volume platforms or use tools like the Interactive Brokers platform, you'll notice that implied volatility on Rivian options has reached extreme levels. This indicates that the market is preparing for massive swings as we approach the formal second-quarter financial results on July 30th. Institutional positioning shows that while some funds are hedging their equity positions with put options, long-term wealth management desks are viewing anything near the 52-week low of $11.57 as an accumulation zone. They see a company that is successfully separating itself from the rest of the struggling EV startups, even if the path there is incredibly bumpy. Let's look at the macroeconomic environment that Rivian is fighting against, because no carmaker operates in a vacuum. High interest rates have historically dampened consumer demand for expensive luxury electric trucks and SUVs. Consumers looking for investment help or managing self-investing accounts have become highly defensive, allocating capital away from speculative growth names and moving into safer assets or diversified fidelity ETFs and broad market instruments. This sector-wide pressure forced Rivian to completely re-engineer its manufacturing processes at its Normal, Illinois facility during a recent shutdown to wring out costs. The cost-cutting measures are working, with negative gross margins narrowing, but the business is still losing tens of thousands of dollars on every single vehicle it rolls off the line. Comment below how many shares of Rivian stock you currently hold, and whether you think management made the right choice by diluting shareholders to secure more cash. Now, let's step back and look at what this company actually does and how its core business model functions. Rivian positions itself as an adventure-forward electric vehicle builder, focusing heavily on a segment that traditional players have struggled to electrify efficiently. Its flagship consumer vehicles, the R1T pickup and the R1S SUV, were designed from the ground up on a proprietary skateboard platform that integrates the battery pack, powertrain, and suspension into a single modular unit. This engineering approach allowed them to capture early critical acclaim and establish a highly premium brand identity. Additionally, their commercial van division, heavily supported by an initial 100,000 vehicle order from Amazon, provides a predictable commercial revenue stream that acts as a buffer against consumer market cyclicality. But past performance highlights exactly why the stock has been so heavily penalized since its historic initial public offering. When Rivian first hit the public markets years ago, it was valued higher than traditional automotive giants, despite having almost zero revenue. The expectation was that it would seamlessly mirror the production ramp of an established player like Tesla stock or tech giants like Apple stock. The reality was a brutal lesson in supply chain logistics, parts shortages, and factory floor inefficiencies. For multiple quarters, the company missed production targets, burning through billions of dollars of its initial cash hoard. This is historical context that makes current investors so sensitive to any news regarding capital raises or share issuance. Looking forward, the investment thesis for Rivian centers entirely on a single concept: achieving positive gross margins. Management has repeatedly stated they expect to reach modest gross profitability by the end of this year, a target that many Wall Street analysts view with deep skepticism, given the competitive pricing pressures in the mid-size vehicle market. The primary catalyst for the stock over the next 12 months will not be the premium R1 series, but the operational execution of the R2 platform. The R2 is designed to be a smaller, far more affordable mid-size SUV priced around $45,000, which opens up the brand to a massive consumer demographic that simply cannot afford an $80,000 luxury truck. There are two distinct scenarios that could play out from here. In the bullish scenario, the cash raised from yesterday's share sale provides the exact financial bridge needed to scale the R2 line without operational hiccups. If Rivian can maintain its upward delivery trajectory, report lower than expected losses on July 30th, and leverage its massive industrial partnerships to lower component costs, institutional capital will flood back into the stock. Portfolio managers utilizing sophisticated systems or executing trades via an interactive broker's account will look past the short-term dilution and value the company based on its multi-billion-dollar future revenue capacity. Under this outlook, the current price could look like a massive structural discount. The bearish scenario, however, is rooted in the harsh reality of execution risk. If the R2 production ramp suffers from the same logistical bottlenecks that plagued the early days of the R1, Rivian's cash burn will accelerate once again. Even with the newly acquired capital, another round of dilution or reliance on expensive debt markets would completely shatter investor confidence. Furthermore, traditional car makers are rapidly adjusting their strategies, introducing hybrid options and lower-priced electric vehicles that compete directly for the same consumer dollars. If the broader economy slows down and consumer spending on big-ticket items deteriorates, a high-growth, unprofitable automaker will face severe valuation compression, regardless of how popular its brand is on online investing sites. When you evaluate Rivian against the broader market, you have to realize that the old playbook of valuing EV companies on pure volume growth is completely dead. Today, the street demands structural capital efficiency. Investors who manage their own individual brokerage accounts or seek professional wealth management look at Rivian not as a tech stock, but as a manufacturing company that must eventually generate free